Welcome to Agent of Wealth Podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps small business owners and retirees overcome the multiple wealth planning challenges involved in your financial life. We do this by creating comprehensive wealth management plans to guide you towards financial freedom, ensure you never run out of money, and help create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth planning issues involved in your financial life.
Hello and welcome to the Agent of Wealth with Marc Bautis of Bautis Financial. Today we're going to be talking about student loans, and the title of today's podcast is Putting Together Your Student Loan Financial Plan. And Marc has brought in a special guest, and I'm going to let Marc introduce his guest. We're on 3 different locations today, so this is kind of fun, something new for us. So I'm just going to greet the gentleman and welcome to the show. Good morning, guys. How are you?
Morning, Eric. How are you?
I'm good. Marc, you brought in a special guest today. Who is that guest?
Yeah, so today we have Jan Miller from Miller Student Loan Consultants. And what we're trying to do today, in episode 11, we talked about someone having a new baby, what are their options for saving for college? The following episode, episode 12, we talked about, okay, your child is approaching college, how best to pay for it. Mm-hmm. And today we want to just follow it up with, all right, your child has finished college and now they may have some student loans, and what's the best way to tackle those student loans? So welcome, Jan, to the show.
Thank you. Yeah, it's great to be here.
Yeah, so Jan, maybe you can start with give us a little background on how you got into the student loan niche.
Yeah, absolutely. So about a little over 20 years ago, believe it or not, I was a professional opera singer. And when my daughter was born, I decided to get a job that was a little bit more stable, where I didn't travel around so much. I ended up working for a company at the time was called Unipac, which is now Nelnet. They're a student loan servicer. And it kind of just kept me in that field for about 8 years. I worked for 4 different loan servicers, and then in various different departments, kind of saw the whole issue from a macro and a micro point of view, and noticed that it affected all demographics. And from there, I eventually went into the financial field. I became an investment advisor with Morgan Stanley for a number of years, all the while helping people with their student loans in the background on the side. Until in 2010, the demand was so great for help with student loans and my expertise on it that I retired from Morgan Stanley and made student loans my sole focus and opened my company.
Sure. And I guess if you look at, I come across a lot of people with student loans, but I guess they're so prevalent out there and so complex that you probably are seeing all different cases of student loans, and kind of how, I guess, people approach them is all different.
Yeah, it's a couple of things. The first thing, of course, is that it is complex. Not only are all the loans governed by regulations and different loans qualify for different programs, but there also there's grandfathering, which means that depending on what date you took out the loans can inform exactly what programs you qualify for. So, and then if you want to mix that in with your own financial objectives and how to balance the two together, you've got quite a unique scenario for every single borrower. That's the first thing. The second thing is that the resources available to borrowers that are truly helpful are quite limited. Of course, you can go to studentloans.gov or, federal student aid's website. Then you might as well be opening, the tax code at that point, right? So you're looking at things that, how does this make sense for my situation? And then you have the loan servicers who really aren't well trained. They basically tell you what's in the best interest of the servicer. And, they're limited in that regard as well. So, and they give wrong answers quite often, unfortunately. So people need real experts to come in and make sense of it all, not only in general terms, but specifically for their individual situation. That's what I do.
And is like, I guess, a typical engagement, someone comes to you and says, I have these student loans, I have no idea what I should be doing with them?
Well, a lot of times people, when they come to me, they've already talked to their loan servicers or failed at achieving what they've needed to through the typical resources. But they may know nothing about it, or it'd be very, limited in their understanding, or they may actually have already done a lot of research only to find out that they still can't figure out the best way forward. So typically what I do is most of my clients have started out with a free consultation or an initial consultation with me, where I do an analysis, a quick 30-minute analysis of their situation to see if I can't just help them immediately over the phone, or if they need additional work after that. But I can determine if they're suitable for long-term help, or if I can just tell them what they need to know right there and then.
And so let's say you do engage with someone. How do you approach it? Do you, I guess, look at what their current loans are, what the terms of the loans, and then go over the different options that they would have to approach repayment?
Yeah, I don't actually. The nice thing is, and this is one of the things that differentiates me from some of the other companies that do similar things, and that is that I won't ask for any personal information. Actually, I don't need their social security number or their FSA ID, or I don't need to log in and look at their accounts. I can actually just as long as the borrower is prepared with that information, I can gather the information. So I need to know, what their income is, what their income growth looks like, a little bit about what their financial objectives are and what they can afford monthly, some very basic things, as well as the basic structure of their loans. How much of it is federal, how much of it is private or institutional or Perkins, and what the interest rates are and what the name of the loan servicers are. That, there's about a dozen basic questions that I'll ask. And then I can actually take that information and put together a pretty thorough assessment of what they should be doing based on that. And then we can go from there to see if it's going to take more than a half hour course to implement.
Mm-hmm. And what are some of the options that they would have for implementing?
Yeah. Okay. So there's basically what I call the 4 pillars of student loan repayment, and they are refinance, forgiveness, income-driven repayment, and payment targeting. So obviously, I rarely advise a borrower, just pay it as it is. It's a 10-year plan, pay the loans off until it's gone, accelerate your payment if you can. That answer just rarely happens. But usually you usually don't want to follow the traditional repayment that it's going to automatically put the loan in. There are usually better things or better options, no matter what your situation. But those 4 things are going to be the main things that I analyze. Obviously, if they need a lower payment, that comes into play as well. But typically, as far as long-term strategy goes, refinance, public service loan forgiveness, income-driven plans, and payment targeting are going to be the 4 things that I'm going to look at to see if they can help the borrower's situation.
Yeah, I guess on the first one, on refinance, is that starting to make more sense with interest rates going up? And I guess a lot of these loans do have a variable interest rate.
Well, federal loans are all fixed since 2006. So unless you have very old loans, you're likely to have a fixed loan. And if you've consolidated your loans, that's also going to be a fixed interest rate on the federal side. In a private student loan refinance, the lender is going to give you the option. So if let's say you apply for SoFi or Common Bond or DRB, they're going to come back at you with an offer. It's not going to be just one offer. It's going to have a grid. So pick your term, pick whether it's variable or fixed, and this is the rate and payment that you'll get as a result of it. Obviously, you'll want to pick the one that creates the lowest interest rate with the payment that you can afford. And traditionally, people, especially on a conservative side, will choose the fixed option if they can, because then there's no risk of the interest rate going up. Sometimes the variable rates can be enticing though, because they'll be lower to start anyways than the fixed will be.
Mm-hmm. And I guess a couple of questions I have gotten on the refinance side is, if someone refinances out of a federal loan, does that, I guess, wipe away their chance of having an income-driven repayment option?
Completely. So 100%. So once you've done a refinance, and I always, just to make sure that the terminology is clear with clients, when I use the R word or refinance, I'm referring to a private student loan refinance with a company like SoFi or DRB or a Common Bond, Lenkey, Laurel Road, those type of people, where they literally, based on your credit worthiness, refinance the loan and a different bank pays it off, or a credit union. Once that is done, once you refinance the loan, then you forfeit all federal programs forever. Now, it's not to be confused with federal student loan consolidation, which can be confusing because some of these private refinance companies call their refinance a consolidation, but it's not really. A federal student loan consolidation is a completely different deal. That is not based on creditworthiness. It is something that all borrowers, as long as the loans qualify, can do. Only federal loans can be included, including Perkins loans, SCRAP, Grad Plus, Stafford, those type of things. And there's no interest rate advantage to a federal student loan consolidation. It just takes your weighted average of the existing loans, but it does combine them all into one. And one of the key factors, one of the main reasons to do a federal consolidation is to convert all the loans, if you need to, into a direct loan, which is a required loan type to qualify for public service loan forgiveness. So just to make the distinction between the two, refinance is really just like having a bank pay it off at whatever interest rate they offer you.
Okay, yeah, makes sense. I guess one more question that I see a lot on the refinance side, and I guess nowadays we're seeing student loan borrowers probably coming to you in all shapes and sizes, everyone from someone right out of school to people in their 40s, 50s, and maybe even 60s. But a question I get is, should someone are there reasons to or not to refinance and use home equity to pay off some of that student loan debt?
Yeah, no, that's a good question. So with the refinance, and it's kind of the same with refinance and home equity. Home equity, you can get better rates with that sometimes because you've got equity, right? So it's partially secured, where you might even be able to get a 2% rate, something like that. And so what I always tell my clients or anybody who asks, think of home equity as just another tool of refinance that may get you a better rate because it's secured against your home loan. Mm-hmm. Now, whether or not to do it, there are a few things to consider. The first one we talked about, right? You're forfeiting all your federal programs. You want to make sure you're not giving up anything that would be better, because in some cases the forgiveness programs or even the income-driven programs can outperform in total cost the savings you'll get in amortized interest from a refinance. So you want to be sure before you do it, number one. Number two, it's important to understand that refinance lenders, which are basically banks and credit unions, they prefer shorter terms. So that means that even if your interest rate goes down, your payment will likely still go up quite a bit. So, if your best rates are going to be at your 5, 7, and 10-year loan terms, where a lot of student loans can be upwards of 25 years on their, especially on a consolidated debt. So you can watch your payment go up. So you want to make sure you can afford the payment. That's the first thing. The other thing is that you might not even want to bother with it unless your debt to income ratio is outstanding. So if you owe twice as much debt as your yearly income, it's not going to happen unless you're a physician or somebody who makes, 6 figures, which they can often get refinanced at 50% on their debt to income. If you make $100,000 or less and your income is not as high as your debt, it's very unlikely you're going to get even approved. And if you are, the interest rate's probably not going to be that competitive. So refinance, I always say in-house here, if you qualify for refinance, it means you don't need it. If you need refinance, you probably don't qualify.
Sure. Yeah, I see that a lot as well. One of the options that you mentioned, which I think there's a little bit of misunderstanding about, is the public service debt forgiveness program. How does that work?
Yeah, sure. There are a lot of misunderstandings. Of course, a lot of people are now familiar with the federal student aid report that came out and the subsequent Wall Street Journal article that stated that over 99% of all borrowers who applied for this forgiveness were declined. And a lot of individuals, I won't name names, but even individuals, well-known financial people, took that as a smoking gun that the program's not reliable. And actually, that's not true. It was based on a misunderstanding of how the program works. So the program is not, in general, in basics, you work for 10 years for a nonprofit and you make qualified payments based on your income, and the loan is then forgiven tax-free at the end. That's the basics of the program. However, the nuances of the program are much more sophisticated and difficult to understand. For example, it's not 10 years of employment. It's 120 qualified payments that overlap with the time frame that you're working full-time for a nonprofit. So you have to get 120 of those payments qualified, and then once you've done that, then you can actually apply for the forgiveness. Well, most people are going to have gaps in employments or missed recertifications, or not work full-time the whole time, change jobs. These things will actually make the process longer than 10 years in most cases. So very few people have executed 120 qualified payments in a row without skipping a beat. So that's one of the major misunderstandings about the program. And you can't just work 10 years. You have to have 120 qualified payments and be enrolled properly in the program before you can even apply for the forgiveness.
And so is it any nonprofit that enables someone to qualify for it?
Well, not really. So it's any 501c3. So for example, if you work for a 501c3, then it doesn't matter if you're the janitor or what position you have. And if you're full-time, you have a qualifying employer for the job. However, you can work in some situations for a nonprofit that is not a 501c3, but your particular job position, for example, if you're an EMT or if you're, something that's specifically, obviously public service, and those are outlined in the program. I won't go over them in detail, but there are a number of different jobs that fit that description for nonprofits that are not 501c3s. But if you're a 501c3, you're good no matter what, as long as you're full-time and you meet the other criteria of the program. And if you don't work for a 501c3, but it is a nonprofit and you have a qualifying job type, then you qualify as well.
Okay. And the other option I wanted to touch on a little bit was I guess the one you said you don't recommend as often, but accelerating the payments or targeting certain loans over others. Is that sort of referring to maybe using like one of the debt snowball strategies to get these loans paid down?
Yeah, so you may not exactly. So the federal student loans have a flexibility, if you know how the system works, that private loans or traditional debt does not. So in a traditional snowball or targeting strategy, you would have to satisfy the minimum due for whatever loan you have. Let's say you have a bank loan, a car loan, a home loan. You're always going to have that minimum payment due that you can't get out of. And then you'll pay the extra towards the highest rate or lowest balance loan, depending on your strategy, right? And the idea with snowballing is that you knock out the lowest balances first so that you increase your cash flow so you can increase your payment or the amount you pay extra to the next loan and the next loan and so on, versus targeting where you would pay towards the highest interest rate loan and pay extra to that and reduce amortized interest costs at an accelerated rate. Those are the two options there with traditional debt. Now, in order for that to work, you have to actually pay more than your total minimum due, and a lot of people aren't in a position of doing that. With student loans, you can actually make it so that, well, depending on how much debt you have and what kind of debt you have, but you can direct not even lower or increase your payment. You can actually isolate individual loans specifically and knock them out so that your entire payment is allocated, or a great deal of your payment is allocated towards that highest rate loan. Accelerating the loan, knocking it out one at a time until you're left with the lowest interest rate loans, and you're still accruing interest on the other loans, but the amount of amortized interest that you save by accelerating the payment on the higher rate loans outweighs that or exceeds it, and that creates a savings in total interest costs at the end of the loan. So does that make sense?
Yeah, it makes sense. And I guess is there sometimes a combination of these four options that you recommend?
There are, yes. So that happens all the time. Everybody's got a unique situation. For example, I have a client who has a fair amount of federal debt and qualifies for PSLF, or Public Service Loan Forgiveness, but also has a significant amount of private debt, and he can't afford both the qualified payment in PSLF and the payments in the private loans. So what we're doing is we're keeping him out of the PSLF program to start, because he's grandfathered into that program. So that program will always be there for him, despite what people think. And he's going to target the private loan, the higher rate loans, and get rid of a few of them until he can afford the PSLF payment. And then we'll go back and enroll him in the PSLF program. So that's an example where you have to make it work for the borrower's specific situation and map out exactly what the costs are in each scenario, determine which is the best way forward. But in his case, I'm using a payment targeting and a PSLF scenario in conjunction with one another.
Mm-hmm. And when you, put together an analysis, start working with someone, put together an analysis, are these options, are they quantifiable where you can show, okay, if you do this, here's what it looks like over time versus if we take this approach, here's how it looks?
Yeah, well, especially on amortization schedules, of course, that's just math, right? So we can always show them that what the increased payment to the higher rate private loan will look like in amortization savings, which in this particular scenario I'm talking about was in the tens of thousands in savings of interest. And the public service loan forgiveness has to be what I would call an educated guess or a estimation based on income growth, right? Because the payment is recertified each year based on their income, and nobody can see the future yet. So we have to anticipate what we would expect the income growth for that particular borrower to look like. But we can usually get pretty close to what the expected total cost is for that as well and put it all together. So that's one of the things we do within our student loan business plans or student loan financial plans is we map that out for the borrower, each situation in conjunction with what their financial objectives are, determine which one not only fits the best, but also saves them the most money.
Mm-hmm. And I think, I guess one of the things that appealed to your approach is, you could kind of look at it as a consultative approach, and you look at what are the best options. I'm sure there are other debt relief agencies or other types of products and programs. What should people worry about or be on the lookout for when working or looking into some of those programs?
Well, there are a lot of programs, both from employers and there are debt relief agencies out there, that are just slamming people into income-driven plans. There are a lot of pitfalls for student loan borrowers. So the first thing that I always tell people, okay, are they calling you or did you reach out to them? I don't do cold call outbound marketing campaigns. It's the first thing that, to me is a red flag. Are they asking for your social security or personal information or FSA ID on the initial consultation or call? Another red flag. I used to be a financial planner, and I wouldn't even do that with my prospects until they became clients. And that's the way I handle my business here too as well. So, once you become a client, sure, that some of those things are going to be needed. So to make accurate assessments, I really need to see the loans with my own eyes eventually. However, that's not something until we're engaged in a contractual relationship, that's not something that I'm going to ask. So if that happens that's a red flag right there. The other thing too is that, some of the programs, like for example, doctors, and the answer can get overly complex. So, for example, the question is, doctors will say, well, can I get the public service loan forgiveness and an NIH award or something like that, National Institute of Health, which sometimes gives $20,000 to $50,000 per year for some docs. And the answer is yes, we can do it, but do you want to? And let me explain why. So it can get rather complicated in there, but there are a lot of pitfalls to worry about also with your own loan servicer. So again, as I mentioned before, I'm not shy in telling people that these people are very poorly trained and they have attitude problems usually to boot. So don't ever trust anything that even Fed Loans says, or, they may be telling you the truth. There's a good chance they won't. And I can tell you from 21 years of experience working with these companies that they give more wrong answers than they do right. And they can only tell you a very narrow focus of what you should do based on what they see in front of them and what they're trained to tell you. So that's why what I often say, the value of a consultation with a true expert, really, I often save people tens, if not hundreds of thousands of dollars just by the information I give, because every decision you make with your student loans impacts your total cost directly.
Sure. And I know we touched on it before, but it's even though it sounds like it's a simple topic, it's pretty complex the way
it is. Yeah. And basically, it's like public service loan forgiveness. There are 3 requirements for public service loan forgiveness. You have to have direct loans, which are a qualified loan type. It means it's directly owned by the U.S. Department of Education. Not all federal loans are like that. That's number 1. Number 2, you have to be in a qualified income-driven program. There are 4 of them, and you have to be enrolled in one of those. Well, which one should you be enrolled in? Does it affect whether I'm married or separate or single? Do I have kids? What's my family size? It gets you can just blow up into multiple nuances or complications there. And then, of course, the nonprofit work isn't always straightforward. Well, I may work part-time for 2 different employers. Does that count? In some circumstances, yet. So again, it gets very nuanced. Once you expand and magnify the issue a little bit, you'll realize that it's not so straightforward.
Where do you see the industry going? I know it's, we can't, predict what we're going to see, but does the government just wipe away all student loans? Does this turn into, something similar to the housing crisis, or do we just keep going the way it is going?
First of all, there's not going to be a student loan bubble, in my opinion, and I'll explain why. So, again, I was working for Morgan Stanley in 2008. So I was there when the market went and crashed, and I watched all that happen, subprime and everything. Now, with the mortgage crisis, you have a situation really where borrowers, the banks are overextended and borrowers can't afford their payments, and they forfeit or on their loan agreement. The real key to that is that mortgage lenders really couldn't collect or recover the funds. Otherwise, there wouldn't have been a problem, right? Mm-hmm. But they're still subject to traditional rules that surround collections, and their collection rates may be 10 or 20% of the debt. Yes, they can take the house, but there's always a reduced value in that. So the loss is heavier on that side. Student loans are a little bit different. They are guaranteed by the U.S. Department of Education. They have what are called extraordinary collection powers. So they're going to get their money like the IRS. So if you owe a student loan that's a federal student loan, you're going to pay it back unless you go out and live in the woods like Jeremiah Johnson, or you go off the grid, or you die.
They're going to get their money back.
Because they don't have to take you to court to garnish your wages, take your tax return, your 401k, even your Social Security. So if you default on a federal student loan, you better pay it back or set up a rehab agreement or make an arrangement, because otherwise they will take the money from you eventually. And their recovery rate is over 82% on defaulted debt. So you may have 13% of these borrowers defaulting, but 82% of that is recovered, which is a gigantic amount. Most lenders would drop their jaws over that amount. But so because of that, because the funds will always be recovered, it actually makes the loans relatively low risk for the U.S. Department of Education. The second thing is the U.S. Department of Education is getting way over the market on the interest rate right now. So especially with Grad Plus loans, interest rates are 6, 7, 8%. Well, based on the current market, that's an extraordinary interest rate. So with a low risk loan. So because of that, from a fundamental point of view on the side of the government, they're actually doing quite well. It's the borrower who's suffering.
Sure. Well, we're just about out of time. And Jan, thank you for joining us. How best can people reach you?
They can go to my website, which is student-loan-consultant.com. And you can see there where you can click, you can schedule for free consultation or with one of my consultants, or you can do so with me directly, and that information is all there on the website. And that's really the best way to do it. You can also Google student loan consultant, and I'll usually pop up the first one on the organic search results.
Sure, great.
All right, guys, this was great. Jan, thank you so much. That's a ton of information. And as someone who has a 19-year-old daughter, I appreciate it. We're right in that area for the student loans and college planning. And she took a year off, but she's already itching to do some schooling. So got a lot to think about. So thank you so much for being on the show today.
You're welcome. Thank you, guys.
All right, Mark, thanks for bringing him in. And thank you all for listening to the Agent of Wealth podcast with Marc Bautis. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Mark comes out with a new podcast, it'll show up directly on your listening device. This will make it much easier to share these podcasts with your friends and family. Thanks again for listening today. For everyone at Bautis Financial, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment and financial planning.